Morning. I'm Dan Hollander. I'm with Hollander and Loan. And today I wanted to spend a few minutes talking about long-term care. I don't know why, maybe because of the gray hair, but I'm getting more and more questions about long-term care insurance and whether it is something that should be considered in terms of long-term financial planning. I have a contrarian view of long-term care coverage, so let me explain why. Many coverages that shift the risk, which insurance is, of experiencing a health event enjoy a fixed premium. For example, if you have a long-term disability insurance contract, it's non-cancelable and it's fixed at the premium that you take it out. So when you take it out at a younger age, then you're locking in that premium. So essentially, you know what you're paying for in terms of the risks that's being transferred to an insurance company. Not a bad way to do it, and you can make a more proper assessment as to the value of that risk transfer according to the premium that's set. So why is it a bad idea to look at long-term care if it's not the same way? Well, it's because many people who want to know about long-term care are in their 50s, their 60s, sometimes even a little older, but premiums get really expensive then, even at the starting point. But the issue is if you take out a contract that's in a younger age, in your 50s, there's no guarantee that that premium is going to remain the same. In fact, history shows us that insurance companies, in their infinite wisdom, are knowingly setting premiums that are not going to be good guidance going forward. They will increase them and have. So many insurance companies have applied to an insurance commissioner and said, I want to double the insurance premiums. They base it on the claims experience that they say they have. And they're receiving approval by state insurance commissioners to increase the premium. So if you took out an insurance contract for $2,000 as just an example, that was going to pay you $200 a day for a period of time, and suddenly the premium triples, and now it's $6,000 15 years later, many people are going to say, I'm not going to spend that money, and they're going to drop it. So what do? Well, first, you look at what I think is the optimal way to handle long-term care issues, which is self-insurance. Do you have sufficient money to cover the risk? Have you made an assessment to determine that your portfolio can take a hit, even if it's a health care risk? Know this, it's a big number. If we have insurance needs today for long-term care, and let's say they're $90,000 a year, we, in our projections, utilize a 6% inflation factor because healthcare costs increase more rapidly than normal costs of living adjustment needs. So to be realistic, you want to adjust those projections at a higher rate. So then if you look at that projected need and you ask yourselves, will my portfolio be able to manage that? Then there's no need to consider to transfer the risk to an insurance company. Let's assume you don't, though. Let's assume you determine that you're going to feel better about having insurance. How do you handle that? Well, there are some companies now that offer different iterations of a traditional contract where you pay a monthly premium and it may or may not increase. So know this. You have to explore all the options. There are options with regard to paying a lump sum. I'm going to explain that in just a second. There are options in terms of being able to spread that lump sum now over 10 years. There are options such as utilizing an annuity that has a long-term care rider. So having a tax-deferred investment that you now can put a long-term rider on to cover those costs. There are also life insurance policies. Life insurance policies, if you have a need for life insurance, just to be able to have income replacement. Now you can also put what's called an accelerated death benefit on the contract, which simply means that if you were to incur a long-term care event, you could you could utilize the death benefit proceeds. Instead of waiting for a beneficiary to enjoy that upon death, you can use that to preserve their wealth by drawing upon the death benefit while you're alive to pay long-term care costs. Each of the contracts that I just described have their own cost factors and need to be carefully assessed as to, is it a good deal? Let me go back to lump sum. So one of the concerns that people have is, if I put down a lump sum, what does that mean? I mean, you can get 6.5 years of benefits in terms of long-term care benefits, and yet an insurance company will say it commands like a $100,000 deposit. So how do you evaluate that? That's a calculation to determine, is that of value? And then the next question is, what happens if I don't have a long-term care event? And now there are contracts that will allow you to have what's called a return on your premium. So you'll get $90,000 back, sometimes 100%, without any growth. So if you kept the contract for many, many years, you'd get the $100,000 using that hypothetical back, for example, but no growth on that. The other question is, what happens if I die? Now there are contracts that also have a death benefit. Now keep in mind, if you have the lump sum contract, the advantage of that is that they are saying, those insurance companies are stipulating that they will guarantee that that $100,000, as an example, will ensure that you have the long-term care claim covered without them coming back and asking for more premium in the future. So you're locking in the risk that you want transferred at the premium you've stipulated with the insurance company and agreement. So now at least it's something that is more predictable. You can get your arms around. You can appreciate, okay, how do I factor this into the costs of retirement and make an informed decision, whereas the traditional insurance contracts for long-term care that can have premiums increase at 5 years, at 10 years, at 15 years, 20 years out, make it very difficult to determine what type of value you're getting and is it something that you want to consider. So I've introduced a number of different options. I'm not going to explore them deeply here. Know that they're available and know that you should be bringing this to our attention if that's something that, if long-term care events concern you, you know a loved one that's had one, perhaps a parent, you say, I don't want to go through that. I don't want my kids to have to pay for that. Then you need to just examine it and make a decision. But there are some avenues, as I've said, that do allow you to, at least with open eyes, if you're not comfortable self-insuring, the most cost-efficient way to take care of the long-term care risk, there are some ways that are a good alternative to traditional plans that have good contracts, and they include a contract that allows a lump sum premium with a return on the premium and a death benefit. There are contracts that are annuity contracts that have long-term care riders, and there are life insurance contracts that have an accelerated death benefit for the purpose of affording you a benefit while you're living if you have a health care event. That's all I'm going to go over now. I hope it was helpful. It's just trying to get you introduced to some different modalities and be aware that traditional long-term care isn't necessarily the optimal benefit that you want to be seeking if this is a concern of yours. All right. Have a good one. Take care.